So we're going to start with introductions. So we have Brian Yoon, who has joined us today. Brian is CEO of Re-Innovate Studios. So I'm going to let him give a bit of background about himself, but most of you maybe know me, maybe you don't. I'm president of TIMIA Capital. My background is actually on the operator side, so worked for various startups. My last startup was a fintech that did automated underwriting and portfolio management for small business loans, was a white label solution primarily used by financial institutions like credit unions. So I always say I've got a lot of empathy for anyone who is a CEO, founder, operator out there, because it is a tough road and there's lots of curveballs that get thrown along. TIMIA tries to help you guys out. And we're going to take some bigger picture on this for your capital planning and get the view of a CFO in that process, which is why we've brought Brian along with us. I am not a CFO, I'm not a CPA. So we've got someone who really knows this side of it. So Brian, do you want to give a little background on yourself and about Re-Innovate?
No, I really appreciate the time and the chance to speak, everyone. My name is Brian, based out here in New York City, operating Re-Innovate Studios. Our vision is simple. I come from a restructuring background where I helped large cap and publicly traded companies in their sticky situations. Then on forth, I worked at a fintech company and also had a chance to deploy some venture debt and equity capital into the early stage. And I saw the same thing occurring again and again, which was not enough support for the early stage with regards to founders having more so a financial rigor and operational rigor in terms of their modeling and getting access to the capital markets. And so, on that thesis, we were born. And to date, we've served over 20 clients across broadly North America, focusing mostly on B2B SaaS. So nice to meet everyone. And at the end, hope to hear a lot of great questions from you all. So.
Yeah, awesome. And this is our agenda for today, but I will say again, having been an operator, and when you are, a lot of our companies are bootstrapped. In the early days, you're trying to use your funds and your capital and your revenue really wisely. So not everyone is a CFO or a CPA or has that sort of background. So we do have some companies that come in who are looking for a fractional CFO or, some of that consulting advice, maybe don't have it in-house or using, a bookkeeper or an accounting firm. And so we empathize with that. And this is to sort of help you figure out where to prioritize so that you are kind of financially fit when you're looking for capital, whether it's venture capital, venture debt, or an exit, whatever it might be. So we've done the introductions. So we're going to talk a lot about kind of financial due diligence, the context of capital raises and planning, and how that ties into exit options. And then we can get into our QA section. So what I'm going to sort of pick Brian's brain on is which financial metrics are critical for attracting investment. So there's a lot of them that are out there. It's hard to get your reporting set up so that you can track all of them, but that's what we're going to talk about and how that ties into some of the scenario modeling and et cetera. So Brian, I'm going to hand it over to you, but I might, pipe in. It's hard to keep me quiet.
Yeah, no worries. Feel free to stop me at any point. But to just kick it off, as everyone on this call probably has felt, as either being a founder or operator or investor, the capital markets and the broader venture market has certainly become more challenging over the past year. While early stage seed rounds have remained steady at around 3 million, we've seen Series A sizes decrease to 12 million, according to the latest Dealbook data. Post-money valuations for Series A are typically landing between 50 and 60 million, with dilution rates still hovering around that 20 to 25% level. If we look at the broader revenue growth benchmarks of publicly traded SaaS companies, as you know, the picture is actually a lot clearer. As of Q4 of last year, these comps are growing revenues at just 17% annually on average. And this is nearly 40% below the 30% growth rates on revenue that have seen coming out of the 2010s for high growth SaaS companies. To that end, public investor expectations have been resetting as companies are expected to demonstrate more profitability and cash generation versus just banking on hypergrowth at all costs. And this contraction reflects the broader macroeconomic concerns. One, volatility in the public tech stocks impacting investor sentiment, two, a flight towards quality amongst VCs being more selective with their bets, and three, less performant funds and smaller funds unable to raise subsequent funds with more capital flowing to the top quartile investors. And with all that being said, I think it's created a challenging fundraising environment for all sorts of companies in the early stage to mid stage at large. Yeah, anything to add here, Monique?
Do you have a feeling when it's going to improve a bit if we were to,
If I had a magic wand, I wish I had color there. I mean, broadly, I'm sure debt capital providers are feeling the same way today. It's unclear if rates are going to come down this year, especially in the North America region with the presidential election really looming at large. I think depending on either candidate, we still expect rates, as we've seen in leading indicators with mortgages, that rates will likely stay more likely the same, if not higher, which means that broadly, growth stocks are going to be impacted further. And so, to that end, in terms of the VCs that I know, in terms of the family offices and private investors that I've heard at large, I feel like this sentiment is here to stay for the next 2 to 3 years in terms of tighter box, in terms of an investor box that people are really willing to throw money into, and options for capital really being constrained. And I think that is broadly the reason why things like non-dilutive financing is become more prone to be an interesting form of capital today, as it's less so based on longer term projections, but more so on the metrics of your business that you could sharpen and present to investors that gets them comfortable. So yeah.
So you don't think in 2025 that valuations might improve a little bit, or investment money might start to?
I think broadly it depends on the sector. I think B2B SaaS will be a sector that's challenged because of the fact that overall an expensive valuation is more or less being tailored towards deep tech related companies, whether that be in the chips, in the AI based companies that really deserve that valuation. But broadly for B2B SaaS, because a lot of it can be spun up really quickly with the help of a lot of LLM based generators and wrappers, I do think that overall valuations are here to get compressed in the next 24 months. But who knows? That's
making people happy on the call.
Yeah. Unfortunately, I'm here to give you guys
it's true. Yeah.
guidance.
No, I'm just kidding.
But yeah, from our vantage point, from having worked closely with a lot of startups in the North American region, we estimate that roughly a third of companies currently have less than 6 months of runway based on their current burn rates. With compressing valuations, as I've just talked about, in a more conservative financing environment, we expect another wave of startups having to make tough decisions around downsizing, pivoting, or even winding down operations altogether if they're unable to raise new capital over the next several months. Founders will likely need to think broadly about their unit economics, overall cash flows, and operating leverage, and new product developments to weather, overall where this economy is headed in the next 12 to 18 months. So.
Yeah, and I would say in our portfolio, everyone got the message about managing burn, and most of the applications we have coming in have the burn levels are much different from kind of 2 years ago, et cetera.
Yeah, and to your point, I think there's a silver lining that many founders have overall become more disciplined and pragmatic about cash burn management amid these conditions. Although the AI market is making a little bit more of a blurred line in terms of where that frenzy towards growth at all costs versus conservative growth lie. But initiatives like rationalizing headcount, delaying capex, and trimming excess costs are really being looked favorably upon investors to extend your runways at large. And with that being said, today I think it's clear more than ever that metrics don't lie. Metrics open doors to venture debt investors, VCs, and family offices more than before. And here, what I've shown is a high-level cheat sheet that can help you position yourself for market success. And starting from the ARR growth rate in terms of multiple, in the less than $1 million ARR range, which is very early stage, the median ARR growth rate is roughly 30% annually. However, the top quartile companies are over 400% hypergrowth as they capitalize on initial traction. This is obviously very rare and is an outlier, but it's a helpful skewing of data to understand where the overall top performers are and where the median is in the overall B2B world. As you move on to the $1 to $5 million range, growth expectations ramp up with medians around 53%, but the top 25% are still pushing triple three-digit ARR growth north of 100%. Other critical metrics, as I've laid out here, relevant to this group, is probably CAC payback, as well as net dollar retention rates. For that $1 to $5 million segment, the median CAC payback is roughly 22 months, meaning it takes almost 2 years to recover from your original customer acquisition costs. But the top performers have that down just to 9 months through more efficient sales motions. Net dollar retention, on the other hand, which measures revenue from retained from existing customers after churn and expansion effects, needs to be over 100% growth in general in this climate for a healthy growth engine, and broadly indicating to investors a healthy magic number, which is another measure of sales and marketing efficiency at large. At this stage, the elite companies are seeing well over 105% median net dollar retention, which basically means that for every incremental dollar that you put in, you're really printing cash on your gross margin that you're getting out, for the business. And that's really helpful for venture investors, non-dilutive investors, because as you pump additional growth capital in, there's assurance, aside from OpEx, that overall that the sales and marketing is really efficient enough to generate that net new ARR and product revenue that you would expect at that business. And then lastly, talking about burn multiple, which I personally think is the most important metric today, which is a function of annual net burn divided by new plus upsell revenue, subtracted by downsell and lost ARR. We would advise, to anchor to the medium number in this case, as the top quartile players are definitely pressing the gas pedal for growth. So for example, if the company burned roughly $2 million in the quarter while adding $1 million to its ARR, that's a 2x multiple, right? Very reasonable for an early stage startup. On the other hand, if the company burned $5 million in Q1 to add $1 million of net new ARR, that's a very terrible burn multiple, and probably gives caution to the business to really understand, the efficiencies as to where the business is heading in the next couple of months, because, that's not a sustainable funnel from a top-down overall funnel analysis. And so, yeah, feel free to screenshot and use this page. It's thanks to Emergence Capital's data. But this gives you a really good understanding on a high level how to quickly assess your performance versus your overall benchmark peers. So
I do have a question on this. I know we debate you. I push back on some of these numbers because I think from a venture debt, like for instance, growth, we're happy with a lot lower growth, like 20% is year over year growth is great. We look at quarterly growth, even given the climate of the past kind of year or two, if it's between 10 and 20, that can be a win for some of these companies. And we sort of look for lower burn. We don't like companies to be burning more than 50% of their monthly, their MRR. So do you think this is more for like a big equity raise or exits, or both, or same, different?
Yeah, I mean, it's hard to splice, as you know, there's no one database that tracks only venture debt investments on a private company database that allows us to slice. These are the metrics that are getting funded only within the context of venture debt and non-dilutive financing. I will say this is very much so skewed, which is why the green here, which is the top quartile metrics, are a lot higher in general, right? Or not green, I'm sorry, the black.
So I agree with you. So are you saying it's more for like exits, or if people are doing a big equity round, or both?
I think it's the latter. This is more so hinged upon a larger equity round that investors will likely anchor around and would like to see. But to your point, if you're considering other things like venture debt, these metrics can definitely come down lower, as the functions of that will be on consistent revenue month over month growth, and that you're presenting a cadence of of revenue that's sustainable, that you have a robust pipeline. Two, your CAC payback, or broadly, you're getting more efficient as your overall LTV for the business, for the incremental companies that you're bringing on. Three, as you're growing that side of the business, your burn multiple is not growing, and that overall you're really, optimizing your OpEx and margins of the business as you're growing as a business. I would say broadly at large, with that being said, on top of, having a healthy capital stack, gives most of the checklist items for a debt investor or non-dilutive investor to get comfortable around a business to start off that term sheet process. So, yeah.
Great.
Yeah, and this slide, it's kind of like a personal, qualm I have working as a CFO for businesses and broadly companies that come to me seeking counsel. What I presented here is a side-by-side of a company's financials for a seed stage healthcare tech company versus one which is in the hardware business, which I've advised and revised their financials for. Broadly, you could tell from the beginning that, there is a lot of differences here. I guess in the bad case, which, to the left, bad case, the companies generally tend to flood raw data and metrics without clear synthesis and untraceable formulas spread across spreadsheets, right? And that's really important because as an investor, financial packaging is everything. It's not only the story that you're presenting, but the traceability and the auditability of the story that you're presenting to the raw numbers that is being backed up by accounting, as well as just, the broader story that you're generating with the margins, with the costs, and the overall cash flows of the business, right? In the bad case as well, there's overall disconnected financial modeling across the operating plan, the headcount, and the P&L, where there's not a cohesive understanding for a company to understand if you move this 1%, there should be some correlation if you move cost in terms of how much overall revenue you should generate. But there is that disconnectedness that an investor might get uncomfortable around, especially if you're asking for investors for a certain amount of capital. If that is not rationalized and thought through into financial modeling, that's tough, right? Because that's not a full cash flow to better understand the accounting needs of the cash, right? And the last piece, I think it's really important for investors to have a formulated thinking on optimal capital structure, right? Like, what does the funding need really look like in terms of percentages of allocations to overall dilutive capital, non-dilutive capital, and how much can your business rationally support if you're considering a merchant cash advance or non-dilutive capital, how much interest can you reasonably bear within the current EBITDAs or net operating income for your business, before you go out and say, I want to raise $2 million in venture debt, right? You have to understand, what is the actual ability of your cash flow is in terms of bearing that on a leverage perspective. There's other metrics like EBITDA to net debt and net interest coverage that helps you figure that out as well. And on the good case, to kind of shine light to kind of the stars here, I think good companies always present a very tightly integrated and dynamic financial model with no ownership over kind of the secret behind the formulas and all that good stuff. I've found it more and more so that companies that are more transparent, that are willing to give investors everything from a bottoms-up build, are the ones that are the most thoughtful and more so helpful companies that you would want to work with on an overall diligence, term sheet, and investment process. And the more that you provide a robust and concise model, is more of the conversation will be hinged on, hey, so what happens if we tweak the burn down like this? Or what happens if you incorporate this new product? What would that do for your overall growth of the business? I think what's important for founders is to realize that you want to make sure that you have a dialogue with an investor rather than giving them a piece of paper that they're not going to audit, right? You want them to dig into the story of the business with you. And I think, having that traceability, having that concise, clear delineations of a company's financials and use of capital, I think these are really important things that companies can really anchor around. Yeah, go ahead.
I'd just make a comment on that, yeah, for us, I agree with the transparency and like, we don't want to spend a bunch of time trying to figure out what you've done and what's going on behind it. We want to, if we can understand that, we would rather get into the discussions that you're talking about of like, okay, let's talk about these different scenarios and is that too aggressive? And what if, what if you had a more moderate view and, does it make sense? I don't know if you've talked yet about, this kind of sales and marketing efficiency and be able to, put the gas on that. And does that make sense? If you injected 500K into that engine, what's that going to get you based on historicals or what you've modeled out
Yeah,
for added revenue?
for sure. I mean, I think you bring up a good point there. A lot of founders that especially don't have that experience in financial modeling typically have the idea that most financial models need to be hockey sticks. But yes, generally investors love seeing hockey sticks, but there needs to be rationale behind that, right? So for every hockey stick, there needs to be incremental OpEx or costs that are associated with it that makes it a reasonable growth for an investor to fathom. And to your point, metrics like magic number that really looks at the gross margins of a business as a function of their sales marketing expense on a trailing 3-month quarter basis are very helpful to look at when you're thinking about, okay, we're at a 2x magic number. That's a very healthy number. We could rationalize that, assume that going forward, and use that as a projection for, on a high level, what our sales and marketing costs are going to be for the months ongoing ahead, rather than all of a sudden decreasing the 10K of marketing budget that you have to 5K and saying your growth is going to stay the same. That's not going to really fly by an investor. So really staying consistent with what the historic numbers are giving you and telling you are really helpful for investors to realize, okay, like you guys are really thinking about this from a downside case first, which we'll get onto later on as you think about different sensitivities and analyses that you could build into your financial model. That's helpful to investors to digest as well. So, yep.
As always, the time just flies by here. So we just wanted to talk about kind of the different stages of growth and how to prepare for all of these things. So I like the idea of, so you've got your money. So we often ask this at companies, like, where is this taking you? So is it in 2 years' time you want to do an equity raise? Are you trying to go for an exit? At one point, how do you model that out? So maybe have some advice for startups, like you've got this money and you had your initial model, maybe when you applied for the venture debt or the equity, now you've got it. How do you keep your models updated, and how do you adapt to the unpredictable things like plague of locusts and things like that?
Yeah, no, that's a great question. I always like to advise our founders to one, understand what you're really trying to get out of this ultimate path for the business, right? Are you looking to build this to be a lifestyle business? Is this a 10 to 15 year exit? Are you looking to really put the gas pedal on equity capital to grow this as furthest as you can to go to an IPO? Are you a business that's really anchoring around getting acquired by a strategic partner, right? These are all things considered, mapping out where your business ultimately is in terms of its growth life cycle and the incremental capital that you'll need to hit your ultimate milestone of whether that be acquisition, continuing to operate, or IPO, right? And to that end, your model should always be actively iterating and be used as a strategic vehicle for you to understand where your business is heading.
So do you do that on a quarterly basis, or is that too often?
I honestly think a founding or executive team's efforts should not be always just refining and tweaking their models on a month to month. So to your point, I think it's very helpful hygiene once you have people like official board members or other investors involved in your company, that you're producing forecasts on a quarterly basis that you could really sit down, talk about the growth drivers and assumptions behind, which are really helpful to get just honest around as an executive team and as for founders broadly. Because if you have less than 3 months of cash left and you're saying we're going to do these new products and do all these new cool features, that's not really rational, right, in terms of where your headcount is going. And so yeah, I think on a quarterly basis, it's a really helpful exercise for the business to do.
Okay. So how do you, so we're also, I mean, some may do an IPO. I always think like an actual exit, not an equity, round, but an actual exit.
Monique, I think we're getting a little static on our end.
It's
If that's not
either
me.
competitors, customers, partners, um, that type of thing. You got any advice for, I don't know. I think we're all sound okay?
Yes, you're good now.
Yeah. Okay. Maybe it's you. Make sure you lean in to the earbuds. Yeah, just thinking of, they're thinking about who might acquire them. Have you got any sort of strategic advice on, kind of how to map out potential acquirers and where you're at and kind of understanding what they're needing or looking for?
Yeah, I actually think this is one of the most interesting things that a founders can do when really being in the earlier stages, as it relates to one, even in their pitch decks, a lot of great founders know exactly who their potential acquirers are from day one. And you're really building a product suite and business around that, right? If you're going to be an IPO business, one, understand what your broader TAM is going to be. For you to IPO, although there are small cap, mid cap, and large cap companies that are not billions of dollars, broadly speaking, if your business is not going to be that large as a function of your TAM. So, for example, you are looking to be a B2B company for window cleaning companies across the United States, a very niche TAM with a very specific use case. And if you run that, I'm sure it's probably north of $100 million, but broadly, I would assume that's less than $1 billion worth of enterprise, value, right? And to that end, if you know that about your business, before you bolt on different products, you could better understand that, okay, if that's the case, our strategic angle should be to, one, be acquired by a potential window cleaning company in the next 5 years, to which we could assess a value of 50 to $60 million, right? I think that's a very much more refined way of, one, optimizing your burn that you are required as it relates to R&D and sales and marketing for your business. Two, getting in front of these strategic conversations earlier, to get them aware that you are in the scene and you're really looking to disrupt their incumbent industry. And three, if you're looking to go that gas pedal IPO route, you're really, you do need to pick a wider net in terms of the problem that you're looking to tackle, and how you're really going to, chop that, as it relates to, communicating that to investors and getting them on board as well. Because that's a 10 to 15 year conversation versus, an acquisition may be 3 to 5 years, right?
So we talked a bit about scenario planning here, and I think this is anything an investor does, is like, what's the very, very worst case scenario? Like things go bad and what happens here? You've got, the existing runway, so like the status quo, and then you've got kind of a couple different scenarios if you get the capital injection. Any advice here for people?
Yeah. Again, like, take this with a grain of salt. This is just what's helpful for me, because I used to be a debt investor. So I always like to look at things from, a bottoms up perspective, right? Looking at the worst case and layering in different conditions based off of, positive signaling from the market and overall what the business can fathomably sustain. And so option zero is basically your, rundown scenario. It's essentially the baseline path. If you do not raise any additional capital beyond your existing runway and cash reserves, that's a really helpful model to have at all time, because you can model out how long you could operate, potential cash crunches, and what ultimately needs to be cut back or shut down as a broader business. Option one, that's just layering in your growth trajectory and cash flows if you simply continue your operating plan and extend the runway marginally. Option two, that's modeling raising a capital growth round, likely equity plus potentially some debt component, and allocating these funds towards some targeted growth investments like in sales and marketing, R&D, hiring and new product and market expansions, and so on. And lastly, on the growth case, that's really the bull scenario where we analyze an opportunistic raise to really put fuel in the engine, right? So it's investing heavily across the board to enhance hiring plans, potentially even M&A, inorganic growth, and expanding to new verticals or geographies and so on with this capital. And you can really stress test this upside growth potential with the other options to really understand, with all that in mind, which is the most feasible business plan that, your board, your exec team, and your team could really anchor behind. So, yeah.
So I know we've got some resources. We have some case studies that we'll put in for people who have exited, and we have, exits in our portfolio that have been like home runs, sort of, okay, I'm not good at baseball, whatever the analogy is, first base, second base, home runs. So there's a few different sort of resources that are there. I don't know if anyone who's online has any sort of questions that they'd like to ask based on, the scenario that you're at. I know that, we always try to help our clientele get to where is your next milestone. Sometimes it's a revenue target, sometimes it is, an equity raise, or they're actively looking for an acquisition. And the thing that's really hard is how the market can just change. Like we all saw in 2023, how the market can change. Stuff can happen with the deal, and it sort of goes sideways, things that are out of your control. So it's hard to time these things, right? I mean, you can try, and then, some people get lucky with the timing and some people are unlucky, and then you're kind of waiting for that next cycle. But I think it is always, good to have that goal in mind. And I guess what I always think, mainly what revenue and what burn are you at? Because everybody's looking at burn. They didn't used to look at burn as much. There was a tolerance for it, but that's the tricky part now, right? To how do you grow and not burn too much? That's really challenging. Anyone have any questions? Or I know we're a little bit over time here, so if you don't have any questions, you can always reach out to me. You can reach out to Brian for some advice. If you've got any thoughts on anything, then we can wrap it up and let everyone go. We've taken up a little more of your time than we thought. So I want to thank you all for taking part. We'll send out a recording of this. We'll send out some of those resources, and, open the dialogue. Let us know what you think.